And welcome to ETF Edge, your go-to place for everything exchange-traded funds. I'm your host, Bob Pisani. Inflation and Bitcoin remain the two big stories in the ETF world. Let's dive into both with Anna Paglia. She's the global head of ETFs and index strategy for Invesco. Jim Davalos is the portfolio manager at Horizon Kinetics. He manages the Inflation Beneficiaries ETF, symbol INFL. And my old friend Dave Nautic, he's the CIO and the director of research at ETF Trends. Anna, on Friday, the SEC rejected a pure play Bitcoin ETF. Now, we know there's two Bitcoin futures ETFs trading. Another one's going to come this week. But a short while ago, Invesco decided to withdraw its Bitcoin futures application. Can you tell us why you made that decision?
Sure thing, Bob. We made that decision because after studying the market for Bitcoin futures and looking at the current market environment, we just concluded that it is not the right time to bring a product like that to market. As you may appreciate, the market for Bitcoin futures is in contango, which means it's really expensive to roll the futures. We did a rough back on the envelope math. It may erode 60 to 80 to 90 basis points of performance when we roll the futures. And we just thought, unless you can align the returns of the funds to the returns of the underlying commodity, this is probably something that is not ripe for the market today. This is what drove our decision, but we are fully committed to the pure play ETF.
You know, Dave, Van Eck is launching their Bitcoin futures ETF this week. I mean, that's three Bitcoin futures ETF we have now. Is Anna right? Is that more than enough players? I mean, Anna's concerns about costs and tracking issues, they certainly seem to be sound to me.
Well, if all we're going to do is get beta 1 exposure to something like the front month futures, we don't need 10 products doing that. I think there's plenty of room for a little price competition. That's what the Van Eck product is. It's 30 basis points cheaper than the two that launched a little bit earlier last month. So yeah, a little price competition I think is a good thing, but we definitely don't need another 10 of these. So a little caution here is probably warranted.
You know, Dave, the SEC rejected the pure play Bitcoin ETF on the exact same grounds they always have. They can't prevent fraudulent and manipulative acts, is the standard quote. Is there anything that can cure this complaint, this long-standing complaint?
Sure, comprehensive crypto regulation, but I don't think we're going to get there in a real hurry. Coinbase came out with what I thought was a pretty solid proposal a couple weeks ago, really asking Washington to give them a single regulator, probably a new regulator that's not the SEC, that's not the CFTC. Now, whether we get that or something else, I think until we get clear regulation of the underlying coin markets themselves for U.S. investors, I just don't think we're going to cross that hurdle. So I think a real solid, physical Bitcoin ETF is probably at least a year off at this point.
Yeah, Dave's pretty pessimistic, but I have to say everything so far indicates Gensler is not going to do anything absent clear regulatory control over important areas of the crypto space, Anna. So your thoughts on this? What are the chances for a pure play Bitcoin ETF in 2022?
Well, I believe that 2022 is going to be the year for the pure play Bitcoin ETF for no reason other than it is a matter of customer protection, investor protection. You cannot really limit the access to markets by investors. And today, investors can buy pure play Bitcoin ETFs in the private market. They can buy it in Europe. They can buy it in Canada. So withholding that type of access here in the U.S. does not do anything to protect the same investors that the SEC is worried about. So I do believe in regulation. I do believe that Gensler is committed to providing an environment in which all those risks are going to be listed. And I do think that 2022 is going to be the year for a pure play ETF. And it's probably wishful thinking.
Yeah, I guess the problem is you take Gensler at his face value. If he's not going to get comprehensive legislation that clearly indicate who controls what, it's unlikely he's going to move. I think we're at an impasse here, and we need comprehensive legislation. I'm in Dave's camp on this one. I want to move on and talk about inflation, though. Jim, since launching the Inflation Beneficiaries ETF in January, again, the symbol's INFL, your assets have gone straight up. I see you're approaching $1 billion right now in assets under management. In this, you own land. I understand that. You own energy, and you own Exchanges, that's what's curious to me. You own the Deutsche Börse, Australian stock exchange is very big. Walk us through what you own here and the breakdown. Land, energy, and stock exchanges seem to be the main theme here.
Sure. So the unifying theme across everything that we own is capital light. So we want to remove a lot of the risk that a lot of other types of strategies and conventional inflation-oriented equities take through the capital intensity, the working capital, the balance sheet leverage, the cyclicality. And we express that through these capital light businesses that have very high operating margins, a lot of scale, and so you can really compound through a full inflation cycle. Our exposure, we do it through financial exchanges, we do it through royalties and energy, we do it through royalties in precious metals and base metals. We do it through brokerage firms, brokerages in insurance, commercial real estate, shipping. We do it through agricultural processing companies where, again, they're benefiting from the throughput. Data and research, where you can touch industrials, automotives, healthcare, a lot of industries that you don't get in these conventional in conventional allocations. But here you're getting into these niches of inflation where you're seeing a lot more inflationary forces. But here you really benefit from being kind of in that middleman or toll booth type of role where you get a lot of the benefits of inflation without the detriments of a lot of businesses that are directly upstream in the sectors or subsectors.
Yeah, and it's a fairly concentrated portfolio. The top 10 is a very large part of the overall holdings. But I see Charles River Lab. We've discussed this before. This is a pharmaceutical lab research company. It's your number one holding at about 6% of the assets. Explain the rationale between holding a pharmaceutical lab research company.
Sure. So I think healthcare is one of the pretty hard to dispute areas of inflation over the last 5, 7, 10 years. You can kind of argue how the Fed or how the BLS massages data in other areas, but everybody's seen healthcare inflation. But it's really tough to access it, whether you go through a biotech or a pharma, because of all the capitalized expenditures and what it really takes to create the next blockbuster drug. Then when you go into kind of the HMOs, the insurance, the skilled nursing, again, you're really captive to kind of what the administration is going to do, and you have a lot of exposure to different areas within the cost curve. Charles River, their main business is contract research. So basically they're benefiting from doing the safety and discovery assessment of very early stage of a lot of biologics, pharmaceuticals, and therapeutics. But by virtue of their network of labs, their databases, and their processes, they can do everything faster and cheaper than the leading biotech, governments, and academic institutions. So they can really scale that business and benefit tremendously from volume and pricing pressure within the healthcare ecosystem, again, without being that directly exposed to rising costs, whether it be wages or reinvestment or debt or all these other kind of areas that are more affecting the upstream players.
You know, and Anna, it seems like you're seeing something very similar. Investors are reacting to inflation concerns by adding commodity ETFs as an inflation hedge. Now, you've seen increased inflows into your commodity index tracking ETFs, DBC and PDBC. Tell us a little bit about these and what do they own?
Sure, Bob, you're absolutely right. We are observing this trend today, but it's not the first time. Every time that there are concerns about inflation, investors turn to commodities and use commodities as a hedge. PDBC and DBC invest in a broad basket of the 14 most heavily traded commodities. They span across energy, metal, agriculture, so you understand why, if there are concerns about the rising prices and inflation, you want to have access to this type of commodities. It is the same index used across the two products. They are very similar in the portfolio. It's just a different legal entity structure with different tax consequences, but we have seen significant flows coming into these funds. PDBC started with $2.5 billion this year, is now about to cross $7 billion. DBC went from $1 to $3 billion. And we believe that these flows will continue to drive assets into these funds as concerns about inflation continue to persist in this market.
Yeah, commodities make a lot of sense to me as an inflation hedge. Energy has always been considered an inflation hedge. You can always raise oil prices and gasoline prices. But because inflation also affects interest rates, it looks to me like investors are adding to their portfolios fixed income ETFs that maybe can generate yield while hedging against the negative impact of rising rates. I'm very intrigued by your senior loan ETF, BKLN. Which has had inflows recently. So this is an index of senior loans issued by bank corporations. Tell us a little bit about what does that own, and why would you consider that an inflation hedge?
Sure. That's a good question, Bob, because while investment in commodities is very intuitive as an inflation hedge, BKLN senior loans are not. But if you think about the BKLN portfolio and how it's structured, you will drive a connection between inflation, rising interest rates, and bank loans. So the portfolio of BKLN is comprised of the 100 largest institutional leverage loans. They are issued by banks to corporations. And if you look at the list of the top holdings of the fund, you will find very familiar names, and they include, United Airlines, Burger King, Western Digital, and these bank loans have a floating rate coupon. So if you think about an environment in which there is a concern about rising interest rates, this portfolio is something that may be attractive to you. BKLN has attracted $3 billion year to date. Today is the largest senior loan ETF with over $7 billion in assets.
Yeah, you've also seen inflows. I'm hitting some interesting inflation hedges here into the preferred ETF market. And Invesco has a PGX, which is the preferreds. And I want you to, this is sort of an education moment for the viewers, why are owning preferred shares a bit of an inflation hedge?
They are a little bit of an inflation hedge because, again, it's the same connection to rising interest rates that is driving the flows into BKLN. These funds, and they are PGX and VRP, they invest in fixed rate preferred and variable rate preferred, and they provide income. So for those investors who are looking for income in their portfolio in the face of rising interest rates, these are securities, and this is an asset class that is definitely going to be attractive to you. PGX, that includes fixed rate preferred, has added $600 million this year. VRP, that offers a variable rate preferred, has added $15 million this year. So again, is the correlation between inflation concerns and rising interest rates that makes these particular investments incredibly compelling as part of your portfolio.
Dave, most of the inflation strategies that you hear about, the viewers write in for, the knee-jerk strategy is, I'll buy TIPS, Treasury inflation protected securities. But, looking at these various strategies, like commodities, for example, like even bank loans or preferreds, is TIPS really a good way to hedge against inflation? It doesn't seem to have much upside to it, in my head at least.
The old story is by the time you thought about investing in TIPS, you're probably too late. And I think that that's really true right now. The break even on 10-year TIPS right now is about 2.7%. That means you need to believe that for the next 10 years, average inflation is going to be north of 2.7 for it to make sense to not just buy a 10-year treasury. And frankly, a lot of people don't even want to get that far out on the duration curve right now because, as you point out, we're heading into a rising interest rate environment. It's never been more clear. So what we're seeing is people really bring their duration in. And if they're going into TIPS, they're going in that 1 to 5 year bucket, which I sort of consider cash parking, not really investing.
Yeah, Jim, just give us your overall view on inflation. Of course, the big debate in the world I live in, which is the stock market, and the debate about peak inflation, peak earnings. Are we at peak inflation concerns, and how closely tied is that to the supply chain issues?
I don't think we're anywhere near peak, but I do think it's going to ebb and flow quite a bit over the next 1, 3, 5, 7 years. But I'm distinctly in the camp that we are in a secular inflation environment. And obviously there's a little bit that has to do with supply chain issues today, but a lot more has to do is that we global governments have created and stimulated a lot of artificial demand, and that is basically colliding with underinvestment and malinvestment in a lot of the areas where this demand is flowing into, which is resulting in a structural supply shortage that's just being exacerbated right now by supply chain issues. So again, I think the biggest thing is that there's going to be a lot of fits and starts, but the overall trend is going to be higher. And as you alluded to in equity markets, the multi-trillion-dollar question is going to be, will that affect the yield curve? Because the yield curve is basically interest rates are gravity to financial asset prices. And if the long end of the curve really moves up and surprises people as it moves up, it's going to be a lead weight on equities, especially these really long duration, highly valued tech stocks that have really been the engine powering the market higher. And so that battle between interest rate sensitivity and then real, not to be mistaken with nominal growth, is going to really be the most important narrative for probably all investors over the next 1, 3, 5, even 7 years.
Yeah, and I agree. And history indicates that moderate inflation, stock market does fine. When you get sudden, unexpected inflation, like in the 1970s, it tends to underperform on an inflation-adjusted basis. I want to move on and just ask you, Anna, about this whole ESG business, which always fascinates me. You've struck a bit of a nerve, Invesco has, with broadening out the triple Qs, the NASDAQ 100. You've got a whole family of products around the NASDAQ 100. Besides just covering that, you have the next-gen NASDAQ 100, which is the, I guess, 101 to 200 largest non-financials in the NASDAQ. You've got a NASDAQ 100 ESG ETF and a next-gen ESG ETF. It seems like the perfect storm here between demand for technology, which is the NASDAQ 100, and demand for ESG at the same time.
So, Bob, it's the first time that I hear struck a nerve and perfect storm in the same sentence together with QQQ Gen and Next Gen. So this is great. Yes, we did. We created an innovation suite for everything QQQ, everything NASDAQ 100. If you look at how technology has performed over the last 2 years, I don't think anybody would be surprised to hear that the QQQ went from $66 billion in assets in 19 to crossing $200 billion just a few weeks ago. Performance has been incredibly strong. The QQQ outperformed the S&P 500 11 years out of the last 13 years. So we have answered investor demand by creating an innovation suite. That includes the QQQ, obviously, our flagship product, QQQM. It also includes the Next Gen. So what's better than owning a Facebook? It's owning a Facebook before it becomes Facebook. So the next 100 companies by market cap, we believe, are going to provide the benefits for our investors. And to maintain optionality, we brought in the ESG versions of those indices where performance is incredibly aligned with the mother index, so to speak, the next-gen QQQ and the QQQ, but companies are rewarded for exhibiting good ESG behavior. So we do believe that the innovation suite is resonating with clients. QQQM and QQQJ have raised $4 billion combined over the last 12 months, and we do have a high confidence in the ESG versions as well.
So, Dave, here's the cynical question on ESG all the time. Is there really room for this continuing tidal wave of ESG? First off, you watch the flows very well. You're one of the great experts. Is there really capturing assets under management? We've got $800 billion coming into ETFs this year. Is ESG capturing a significant amount of that, number one? And number two, go ahead. Answer the question. I want to answer a follow-up.
I was going to say, it's capturing a little, right? So it's definitely been the strongest year for ESG we've seen in quite some time. By the time we get to the end of the year, I imagine will be something like 4 or 5% of the flows will have been into ESG-related products. Now, at the same time, we have just a flood of new products. So it's understandable that you're a little bit skeptical with the rash of new products here. But remember, a lot of these products are coming to market at the request of institutions that are making large allocations. Many of these launches this year have come out of the gate with big assets from institutions. So whether you as a retail investor are interested in these products is up to you. The institutional market, they're voting with their wallet.
Yeah, 4 to 5% of the inflows, given the PR that ESG is, I mean, it's incredible the amount of interest around this space. 4 to 5% is still pretty small. Let me ask you about the SEC. Gensler is getting a little nastier about this. He's made very pointed comments about, I want to know, and I want these people to justify exactly what is in this stuff, and I want to be able to better and more sharply define it. Do you think there could be some issues around what is ESG from the SEC in 2022?
I think this is pretty well-covered territory. I mean, you've got the UNPRI, which is a pretty exhaustive list of fundamental principles for ESG investing. It's understandable that regulators may want to be able to put some boundaries around marketing. That happens all the time. That there's all these rules now about what you can and can't put in the title of your fund. But I do think we'll probably see some regulation around, very light touch regulation around what you can and can't call ESG. I actually really prefer it when we actually get really specific with this stuff, whether it's a climate change thing, whether it's a specific social or governance angle. I think there's room in this market to not just have the big broad brushes, but a lot of building blocks as well.
Yeah, Anna, you got the last word here. Is ESG, the tidal wave, you still see it gathering assets under management, right? Do you see any regulatory issues for ESG in 2022?
I don't see any regulatory issues. I think that this market is evolving and is maturing as we speak. We have seen how it played out in Europe, where today 81% of new flows into products went into sustainable products, ETFs or mutual funds. We think that the U.S. market is going to mature as well. I mean, to me, it's all about truth in advertisement. I like what Dave said about, not just painting broad stroke brushes, but being much more focused on what these products are all about. But as long as we continue to be truthful in the way we describe our strategies, I think we are going to be okay. I think this is a market that is going to continue to grow because it is attractive to the institutional audience and the retail audience today. So I see the U.S. following the same trend as Europe, just delayed by a little bit.
Okay, that's it for this week's ETF Edge. We've covered a lot of topics, but we've got three of the best here. My thanks to Anna, Jim, and Dave. We've asked Dave to stick around to talk more about ETFs in our ETF podcast and where we're going to close out the year. Remember, you can see all of our shows on our website, etfedge.cnbc.com. Everybody, have a healthy, happy, and safe trading week.
Get the ABCs of ETFs with the Etf Edge Newsletter, your weekly update on the hottest trends in the nearly $4 trillion market of exchange-traded funds, expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge Newsletter.